Hi, everyone, and welcome to today's webinar. The next recession is coming. Here's your survival strategy, presented by Early Growth Financial Services and Prepared Capital. My name is Amanda Young, and I'll be your moderator today from the EGFS team. And I just have a few quick notes before we get started. This webinar will last about an hour, and that will include time at the end for questions and discussion. So feel free to put your questions into the control panel so we can answer those at the end. The next thing to note is that this webinar will be recorded, and we will send it to all the registrants with the slide deck within 48 hours. You can also find this recording and all of our recordings of webinars on our YouTube channel, which is just Early Growth. Now, without further ado, I'd like to introduce you to today's panelists, Phil Argue, CEO and founder of Prepared Capital, and Alaa Ismail, EGFS Consulting CFO. So first I'll have Alaa introduce himself and talk a little bit about early growth.
Yes, good morning and good afternoon, everyone. Thank you very much for attending. A little bit about me. I'm one of the consulting CFOs here at Early Growth. I've been with the firm for a little over 7 years. And during that time, I've had the opportunity to work on some very, very interesting and great companies, two of which you see on this list, Crunchbase and Glossybox. So I'm very, very excited to be here to listen to this webinar. Early Growth is an outsourced financial services firm. We provide essentially accounting and finance services for a lot of early stage companies. In fact, we do about approximately one in four of the venture-backed companies. We have offices in New York, Chicago, San Francisco, Los Angeles, and in Seattle. We provide essentially 3 platforms of service. We do the transactional accounting work by providing a senior accountant who essentially will do the blocking and tackling for the company. Most of our folks are very seasoned, experienced professionals that understand a lot of different aspects of what early stage companies encounter. So it's a very turnkey solution from kind of the bookkeeping and senior accounting side. We also provide for all our full service clients a CFO on a fractional basis. So that CFO manages the account, is there to help with strategic and operational issues as they arise. So they're there, and they could be as light as you want or as heavy as you need. The other services we provide are, the transactional stuff, accounts payable, accounts receivable. We will do your bank reconciliations. We will close your books on a monthly basis, and we do it on GAAP format. And we also will do financial forecasts, cash management, and the like. Anything really evolving around your accounting and finance. We also provide valuation services. As many of you know that early on, if you have a stock option plan, the IRS requires that you get these valuations under their 409A provision. And we do taxes, state and federal taxes, as well as provide guidance for local taxes, things like sales taxes, and et cetera. So in a nutshell, that's what we do. We support about 18% of privately funded and venture-backed companies here in the United States. And from that, I'll move it on to Phil.
All right. Thanks, Alaa. I appreciate a good rundown on Early Growth Financial. So switching over to Prepared Capital. Look, I realize Prepared Capital is a more foreign name to many of you than Early Growth Financial probably is. So I want to give you a little bit of my background. I think you'll quickly understand why Prepared Capital exists and what our mission is, and it will lead directly into the discussion that we have here today. So just to give you my backstory, I grew up in the San Francisco Bay Area during the 1980s and 90s, and during that time, the San Francisco area was a lot like it is today, where technology was booming. And my mother was fortunate. She was one of the early employees in a startup in 1993. It went public in 1996. So imagine that, a company going public after 3 years. That doesn't happen these days anymore. But that company was then acquired in 1999 by Lucent Technologies. If anybody remembers Lucent Technologies, it's kind of an ominous name, but it was a pretty sizable transaction at the time. It was about a $3.5 billion transaction. And my mother, being one of the early employees, she had a sliver of equity, not a big chunk, but even a small sliver of equity in a $3.5 billion transaction is a life-changing amount of money. But the transaction came with a hitch. It was a restricted stock transaction, meaning when they purchased the company, they gave all the shareholders stock in Lucent, and it came with a contingent that you can't sell it for 3 years. Fast forward about 18 months, and unfortunately, the dot-com bubble burst, right? In 2001, there was a recession, the dot-com bubble burst. Lucent stock went from, the mid 80s, and it was 85 at the time, went all the way down to 50 cents, right? So this life-changing event, which I imagine most of you on the call being entrepreneurs, right? You dream about building a company, having it, getting an exit. It's a life-changing amount of money, and then all of a sudden it's gone. Okay. You fast forward a couple of years. In 2007, I started working at Citi Smith Barney right before the financial crisis. Probably the worst timing ever to get into finance. Citi Smith Barney, or Smith Barney, was sold from Citigroup to Morgan Stanley during the financial crisis. And obviously it was a to say it was a difficult time was an understatement. Layoffs were a quarterly occurrence, if not monthly. Everybody I knew was either demoted, laid off, took a pay cut, not to mention that their retirement, their savings was devastated by the crisis. So I was one of the lucky ones. Fortunately, I put my head down and I put together a decent career there at Morgan Stanley, worked there for 10 years. By the end there, I oversaw 7 offices across the LA area, about 230 financial advisors, and we managed about $33 billion in client assets. So it was a pretty big job. But all the while during my career there, I couldn't help but wonder, and this question vexed me, why did nobody see the crisis coming? Whether it be the financial crisis in 2008 or the dot-com bubble that burst previously, that hurt my family previously. And so I started to do a bunch of research on business cycles and recessions. And that research led me to leave Morgan Stanley last year in 2017 and launch Prepared Capital. It's an online wealth management company. And like many others, we help people invest in financial markets to reach their financial goals. But the difference is that we've got a process in place that protects our clients' portfolios by predicting recessions. Okay, and so those last 2 words that really lead into the meat of this presentation here today. So what we're going to go over, we already covered the welcome and introductions. Obviously, the next recession, it's getting a little bit of buzz in the news media these days. So we're going to talk about how long do we have until the next one comes. We'll share our research here at Prepared Capital, so you understand, why we know what we know, why we've got a timeline as to when this is going to happen, and then we're going to talk about how you can prepare and how you can protect yourself and your business. But first, we're going to talk about what that environment might look like, right? How are things going to change during the next downturn so that you can properly prepare both for your business and for yourself. And so then we'll talk about how early growth financial services and Prepared Capital can help you in different ways to insulate yourself from the impacts. So how did this webinar come about? This was really came out of a chance meeting with David and Gadiel over at Early Growth Financial at a restaurant about 6 weeks ago. It was supposed to be just a quick meet and greet, shake hands, and maybe exchange a business card. And it turned into a 20-minute long discussion about the success rate of startups, the impact that business cycles have on innovation and startups. And at the end of our conversation, we came to the realization that recessions, okay, are likely the greatest financial risk that you cannot control. Okay, the greatest financial risk that you cannot control. And both Early Growth Financial and I felt that this was a topic that we shouldn't just have amongst the 3 of us at a restaurant in Santa Monica. This is a conversation that needs to be had more broadly. And so that's why we're doing this webinar. And at the end, we're going to give you some action steps, both from Early Growth Financial's perspective with your business, as well as Prepared Capital to help protect you personally. Okay. So Let's get into the first question we always get, which is, how long do we have? Look, we are in the 9th year of an unusually long business cycle. If you look back over the last, 115 years or so, the time in between recessions has averaged just 4 years. Okay, we're now in the 9th year. Now, the only cycle that has been longer than this one in the history of the United States was the period during the 1990s that encompassed the story I told you about my mother, that ended with the dot-com bubble bursting, right? There was a recession in 2001, caused the dot-com bubble bursting. So the precedent for long business cycles isn't too rosy, okay? So why do recessions happen? Look, we could get into an entire webinar just about this one slide probably, but we're not gonna get into the weeds here. Look, at the end of the day, it's the Federal Reserve. They control the ebb and flow of the economy. And if we want to get into it in the Q&A section, we can talk about this, but consider this. There has never been a recession in the United States without the Federal Reserve first raising interest rates, okay? Also, there's never been an economic recovery from a recession without the Federal Reserve lowering interest rates. So they really control the ebb and flow of the economy, right? And the end result, which we'll talk about here in a minute, is that recessions are predictable because of this. Now, where we sit right now, the Federal Reserve today has raised interest rates 7 times during this business cycle. Okay, they started in 2015, they started real gradually, and now the pace has picked up some. So they've raised rates 7 times. They're expected to raise interest rates 5 more times between the end of this year or the second half of 2018 and into 2019. Okay, so if they continue on that trajectory, the next recession is likely going to start in the next 18 to 24 months, which is why we're having this discussion now to help all of you take the steps to prepare. Okay, so how do we know? So listen, I talked about my time at Morgan Stanley. Between 2010 and 2014, I, being disappointed in my previous employer's ability to see the downturn coming, I went kind of on my own little personal mission to figure out what causes these things to happen. While I had survived the 2008 financial crisis, I wasn't sure I was going to be able to survive another one if we went through another recession. So as a side project, I put together, I started comparing different pieces of economic data. And there is thousands of pieces of data that are tracked in this country on a monthly basis. And our business cycle indicator, which is really the result of all of my research, is an algorithm that combines economic data and financial market data to predict recessions. Okay. The algorithm can be tested all the way back to 1968. So there's 50 years of data that the algorithm can be tested against. And during those 50 years, the US economy experienced 7 recessions. And we've got the recessions in a table on the right-hand side of your screen there. It shows the month in which the recession started. But importantly, we also show the month in which our algorithm, our business cycle indicator, provided a warning that a recession was imminent. Okay. And for each of those 7 recessions, our algorithm provided a warning in advance of the recession. Okay, on average, 13 months in advance. Okay, it never produced a false positive, meaning it never gave a warning and the recession did not occur. And there's also never been a recession without the warning going off during that 50-year period. So 7 for 7, it's got a perfect track record. And while our algorithm is not warning of a recession today, if the Federal Reserve continues to raise interest rates, some of the internal components that we track of the algorithm lead us to believe that the warning is probably 12 months out, right? And so that's, again, why we're having this discussion today. Okay, before we get into things that you can do to kind of prepare yourself, I think it's important to look at what the environment may look like in the future when this business cycle ends. And so this is the second most common question that we get, is how bad will the next one be? Now, to be clear, our research focuses on the timing of recessions, not their severity, okay? But there are some areas here that we look at that lead us to believe that the next recession could be a bad one. And the first bullet point there that's in bold is probably the biggest point. The 2008 financial crisis was caused mostly by excessive levels of debt, right? It was poor lending standards, people took out too many mortgages, and the whole system imploded. But today, there's 50% more debt in the United States today than there was in 2007. right? So all else being equal, that's a bad sign. Okay, couple that with the second bullet point there. There was a study done earlier this year that 40% of households would struggle to cover a $400 expense in the event of an emergency. So you've got an unexpected auto repair, you've got to replace an appliance in your home, heaven forbid you lose your iPhone, right? That's a $400 expense these days at least. So the brass tacks, or the reality of it is that many of the consumers out there, right, a large swath of the US population is living paycheck to paycheck. So if you're providing a B2C product, you've got to look at it in that context, right? There is an awful lot of people that are not positioned well to withstand the next downturn. Okay, third bullet point has to do with the federal government. The budget deficit that the federal government is currently running was recently updated about a month ago or so to show that the federal government this year is going to spend $1 trillion more in government spending than it brings in tax revenues, right? Now, normally during a business cycle, this late in a business cycle, the federal government would be running a balanced budget, right? They're spending about as much as they bring in taxes, which leaves them some room. When the economy rolls into a recession, they expand spending. They come up with infrastructure projects. The Obama administration rolled out a bunch of spending around alternative energy and green energy. But this time around, the federal government is already taxed, right? They're spending already $1 trillion more than they bring in. So they're gonna have their hands tied a little bit when it comes to expanding spending during the next downturn. Now, it's been 10 years since the financial crisis, and I put a couple of bullet points in here about 2008, just to remind people how the environment changed, right? During the 2008 financial crisis, 10 million people lost their jobs, okay? If all of the small businesses in the United States were a population, that population shrunk by 170,000, meaning there were 170,000 fewer small businesses after the crisis than there were before, okay? And then the big kicker here is that last number. The conservative estimate on the pure financial losses during the crisis was $12.8 trillion. And I emphasize that's a conservative estimate. There are others that put it a much bigger number. But the average person cannot fathom $12.8 trillion. Okay, it's beyond most people's repertoire. So to give you an example, and maybe to help you kind of contextualize it a little bit, if you put 3 stacks of dollar bills on your desk, right in front of your laptop or wherever you are, if you had 3 stacks of dollar bills laying flat, and those 3 stacks equaled $13 trillion, each of those 3 stacks would reach from your desk right in front of you all the way to the moon, right? From your desk to the moon is $13 trillion. And it doesn't even get you the whole way there. You would still have enough money left over to buy a couple of small countries, right? That's $13 trillion. It's an unfathomable amount of money. And that's what was lost during the financial crisis. So using some of these bullet points up above, there's reason to believe that it could be that bad again. And really the first one is on the debt. And so we've got a slide here that we look at the amount of debt in the United States broken out by 4 different categories. You can see government debt, corporate debt, mortgages, and then consumer debt, which is credit cards, auto loans, student loans, things of that sort. But importantly, we show you the amount of debt relative to where it was the year prior to each of the last 3 recessions. So there was a recession in 1991, so we show you 1990. There was a recession in 2001, that was the dot-com bubble bursting, so we show you 2000. And then obviously 2008. So absent everything else, more debt, right, equals more severe recessions. The recession in 1990 was pretty modest and minor. 2000 was more severe. 2008 was significantly more severe. And then here we are in 2018 with $15 trillion more debt than there was during 2007. Okay, so that's a concern, obviously. So we look at this and say, well, what are the impacts of it? Okay, and in here we look at the information from the previous slide, that previous table, comparing it to the decline in the stock market, the S&P 500, just to get an idea as to what this might look like, right? The environment in the future. And for those of you that are analytical, the chart on the right, you probably be able to understand it. It compares the amount of debt versus the decline in the S&P 500 during the last 3 downturns. For those of you that are less analytical, the bullet point on the left is the main point here. $45 trillion in debt, all else being equal, points to a 68% decline in the stock market. Okay. Now, there's no way to know exactly how that's it's gonna play out, because so much of how it plays out is dependent on policymakers in Washington. What does the Federal Reserve do? What does Congress do? What does the president do? So we don't know. But as we begin to look to, what kind of environment should we prepare ourselves for? The amount of debt out there is telling you that the environment's going to be pretty tough. Okay. So fast forward here and let's look a little bit more granular. What sort of areas will likely be most impacted? And before we get into certain areas, I want you just to have this kind of rule of thumb at hand. Recessions tend to reverse the gains or the fortunes that were earned during the previous expansion. Okay, so we talked about the 1990s being the tech boom, and then there was the tech bust, right? The recession happened in 2001. During the early 2000s, it was the housing boom and it was the housing bust, right? So as you look around the economy today, you got to ask yourself, where has money flown or gone to most aggressively? Now, I put 3 bullet points on here, and it's certainly not an inclusive list, right? There's a lot of other areas that maybe warrant discussion, but the first bullet point there, cryptocurrencies and blockchain, obviously that has garnered an awful lot of attention, right? There's now 1,500 different currencies out there, or cryptocurrencies out there. I don't see an environment in which most of those survive, right? If we're in an environment where the stock market is cut in half, or the previous slide down 68%, I don't think that's an environment where all of these cryptocurrencies survive. That being said, separating the currencies from blockchain, there are some real innovations going on with blockchain. I can see, certainly with my background in financial services, where that technology can be applicable, and innovation will continue there. A little bit more, maybe a broader a couple areas here, the last 2 bullet points. So technology broadly, and certainly those companies that are generating their revenue online, is an area of concern. And then the thing that's going to really touch on all of us, and we'll talk about this in a little bit, is companies that are relying on venture capital to fund their growth, right? The environment for raising capital is great for early stage startups, but it's not always going to be that way. And I've got a slide on that, so we'll talk about that in a minute. Okay, let's just talk about technology in general. And this is odd timing, given we put this presentation together last week and now the news about Facebook today. But this looks at the Dow Jones e-commerce index. So this is Netflix, Google, Amazon, Facebook, and about 15 other names. And on the right-hand side, this chart was actually shared by Merrill Lynch a couple months ago, and it grabbed my eye, so I pulled it off. So the e-commerce index is that red horizontal line, or parabolic line on the right-hand side. And they point out that this is the 3rd largest bubble over the past 40 years, right? And they compare it to other bubbles previously. And it's 3rd only to the housing bubble in 2006, right? You can see that on the chart there, and the dot-com bubble that peaked in 2000, right? So a couple of other bullet points here just to kind of put technology into context. If you looked at the market cap, right, the total value of all of the publicly traded stocks in the tech sector in the United States, they're worth about 20% more than all of the publicly traded companies across every sector, across all of the countries within the Eurozone, right? It's about $10 trillion in market cap for the tech sector here in the United States. All publicly traded companies across all of the Eurozone is about 8 trillion, right? That is a anomaly driven by very high valuations. Okay, last bullet point there. I had this on about Facebook. I'll have to check after today's done. But the market cap of Facebook, at least as of yesterday's close, it was $620 billion is how much Facebook is worth. And it was more than all of the companies that make up the broad index that tracks the stock market in India, right? That's the MSCI India. It's kind of like the S&P 500 for the United States. And India is an economy of 1.3 billion people. In Facebook, one company is worth more than all of those. again, it's just a disconnect in valuations, which is great for now because these public market valuations do have a correlation to private market valuations. And so if you're out there raising capital, this is good for you now. But from an investment standpoint, it can be real problematic, as you're seeing with Facebook today. So now let's look at the last bullet point that I had mentioned a couple slides ago, venture capital investments. And I think the chart on the right-hand side is really good because it gives you some perspective about how the business cycle can impact the environment for you to raise capital, okay? The chart on the right goes from 1995 to 2017, and it shows you the dollar amount of venture capital investments each year. Okay, so we span really three business cycles, the 90s, the early 2000s, and the current cycle. And what you'll notice is that there was this huge ramp up in 1999 and 2000. That was the dot-com bubble. But the recession in 2001 caused venture capital investments to fall by 85%, right? An 85% decline in the amount of activity or the dollar amount in deals that VCs participated in. And it wasn't just a V-shaped recovery. All of a sudden it fell off and bounced back, right? It fell off and it took the better part of 10 years to come back, right? So a recession has got a significant impact there. Also, look at those last 4 years, 2014 through 2017. It's been a phenomenal couple years to raise capital because VCs are flush with cash, they're active. This is a great opportunity to be raising capital, but this opportunity will not last forever. And so you got to take advantage. Okay, so let's get into survival guide. What things should we be doing to ensure that we can succeed and maybe even thrive during the next downturn? First, you've got to take advantage of whatever funding sources are available now. I just talked about the environment for raising capital through venture capital. You've got to take advantage of that. If you are thinking that you're going to raise capital in 18 months or 24 months or 3 years down the road, you need to accelerate your thinking, okay? How can you get that done in the next 12 to 18 months? Because when the next recession comes, you've got to assume that there's a funding black hole, right? The market's going to dry up. Investors are not going to be, very receptive to what you're trying to do. There will be investments that do get done. So I know if you look at any sort of industry reports, they talk about the amount of dry powder that VCs have. So deals will continue to happen, but they are going to focus on later stage, well-established companies, the Airbnbs, the Ubers out there, and it's really going to create a void for a lot of the early stage companies out there. So as much as you can, pull forward whatever sort of capital raising you're looking to do. I think it's just interesting to note, I've got a bullet point in here. Facebook was founded in 2004. Right? And in 3 years, right, by 2017, they did their Series A, and it was a monster amount, right? $280 million, which is way more than what most people are going to think about raising in their Series A. However, what's important here is the timing of it, right? They raised all the capital they need prior to the financial crisis. They didn't have to go back to investors to raise more capital. They had everything that they needed to focus on building a great product, building their user base, and it gave them a long runway to build out, right? Who knows how things would have changed if they were forced to go back to investors in 2008, 2009. Their growth rate or their trajectory may be very different. So certainly raising capital is important. The other thing, if you're not having a conversation with your traditional banks about lines of credit, it's certainly not as good as raising capital, but lines of credit are essential. And you should be having conversations with several banks. Silicon Valley Bank stands out because they specialize in early stage companies or startups. But you should be having a conversation with several bankers to expand lines of credit wherever possible. Keep in mind, it's not as good as raising capital because those lines of credit can be withdrawn or canceled during an economic downturn. So just be aware of that. Okay. Next thing I would say, and this is could be one of the most important. You have really got to step into your client's shoes whoever your target audience is, your buyer persona, how is their perception, right? Well, how is their situation going to change during the next recession? If you are a B2B business and you're selling into a company that is struggling, their business is down 25%, how receptive will they be to your product, right? Does it help them lower costs, become more efficient, gain market share? What does it do? The reasons for them to consume your product may be very different when the next downturn comes. I'd also encourage you to consider your customer's customer. So think second level thinking. If you are a B2B business, somewhere in that food chain is a B2C business. So just a broad example, if you're General Electric and you make aircraft engines, turbines, right? They sell their product to Boeing that makes airplanes. Well, Boeing sells the airplanes to American Airlines. All of those businesses are B2B businesses, but they are supporting a B2C business at the end. So take the time not just to understand how your customers' buying decisions may change, but also your customer's customer, right? And then obviously with the B2C environment, same thing. We talked about how there are a lot of people out there that are, living paycheck to paycheck, so to speak. So if people are concerned about their finances, if their investment accounts are down pretty substantially, if they're worried about taking a pay cut, is your product more or less desirable? And can you structure it in a way where it becomes more desirable? This doesn't have to be a lose-lose where everybody loses, okay? Companies will win, and some companies will win substantially. And I put Netflix in here because I think it's a great example. Now, Netflix during 2008, the financial crisis. Now, this is pre-video streaming, right? Netflix didn't have the video streaming service really up and running at that time. It was still the mail order DVD business. But their subscriber base doubled during the financial crisis, right? Their business boomed. And now you could argue it's because the crisis happened, because they were a low-cost alternative to paying $14 or $15 to go into the movies, or paying $15 or $16 for HBO, Showtime, or some premium channels, right? So their business model thrived because the recession happened. So I would urge you, how can you structure your product, your service in a way that becomes more attractive during a downturn? Okay, last couple things for your business. Exit strategies. If you are fortunate enough to be entertaining offers, first of all, congratulations. But keep in mind, as you're making decisions around plans on an exit, or whether or not you take a deal or not, keep in mind that the environment for offers will change drastically with the business cycle. So when we go into a recession, companies are going to be less inclined to make an acquisition. Okay, so just keep in mind, 2 to 3 years out, things may dry up. When it comes to both employment and real estate, these are really cash flow items, right? How do we help your cash flow of your business? Look, it is an employee's market out there. The unemployment rate is down at 4%. If you are looking to bring on quality candidates, quality talent, they are likely entertaining multiple offers from different companies. Wherever possible, I would encourage you to use some sort of either freelance labor, consultants, or outsourced solutions as much as possible. Remember, I mentioned 2008, 10 million people lost their job. Rather than you having to compete for candidates in the environment that it is today, candidates will compete for you, right? The dynamic changes considerably, and it can have a big impact on the finances of your company. Same goes with real estate. If you are in or around a major metropolitan area, the cost per square foot of commercial real estate these days is high, right? But as businesses downsize during the next recession, or they, unfortunately, some businesses aren't going to make it, right? As vacancies rise, property managers and landlords are going to start cutting rents, right? And that's the time when you want to sign a long-term lease, not today. So if you've got your sights set on, some nice cushy office space, hold off. Get by with co-working space, shared office space, squeeze everybody in today, so that you can take advantage of the market environment down the future, in the future, when things get more attractive. Okay, let's switch gears. We talked about the environment, how it's likely to change, how the impact it will have on your business, but importantly, you've got to take care of yourself as well. So a couple of bullet points here on how you can prepare yourself, your personal finances, to insulate yourself from a recession. First, it's basic, but you've got to review your monthly cash flow. What are you spending your money on? You should be working towards reducing whatever discretionary expenses you've got, and building up some sort of a rainy day fund. I would say 6 to 12 months of living expenses in the event that your startup begins to struggle during the next downturn, which is certainly quite possible. You may not be able to, to pay yourself, right? You want to have some breathing room built in the event that that happens. Also, if let's hope it doesn't happen, but during the next downturn, your company doesn't make it, or you find yourself in the job market, if there's 10 million other people looking for a job, it may take you some time, right? So having 6 to 12 months of living expenses gives you some breathing room. And I think that's important. Second bullet point there, if you're thinking about making a large purchase, buying a new car, buying a home, I would hold off, right? Cars always are about the worst investment you can ever make. They all go to zero. Homes, again, broadly speaking, real estate's often a local thing, but broadly, homes over the last 5 years have gone up, in most markets, probably 40 or 50%. It's probably not the best time to either, whether you're a first-time home buyer or you're looking to upgrade your primary residence, probably not the best time to do it. Okay, I would hold off, wait the 18 to 24 months. When we go into a recession, if you are, bulletproof on your finances, you'll have the ability to take advantage of a softer market. You'll be able to buy more home at the same price, or maybe buy the home that you really want at a lower price. So I think it's something to be aware of. And then the last thing on this slide having to do with cash flow, understand the loans that you've got out there. If you have any adjustable rate loans, credit card debt, student loans, adjustable rate mortgages, a home equity line of credit, all of these things move in lockstep with the Federal Reserve. So if the Federal Reserve raises interest rates, the interest rate that you are charged goes up as well. And the bank doesn't have to notify you that your rate increased, right? It's just written into the loan docs. So at some point over the next month or so, I would make it a point to put every loan that you've got down on paper. What's the interest rate that you're paying? Is it adjustable or is it fixed? And have a process for paying down those debts, okay? Okay, next step. Look, we talked about the $13 trillion that was lost during the financial crisis. And it's easy to think like, oh, it's somebody else's money. I mean, no, that's everybody's money, right? That was money that was lost from, everybody in the economy felt that impact. And you have got to take steps now that we're in the 9th year of this business cycle, to protect yourself, right? So first off, you've got to know what you own, right? Take a look at whatever investment accounts you have. Understand not just what you own, but if you own funds of some sort, what are the holdings within those funds? And you want to understand, how do those investments, how are they going to respond to a recession? How did they do during 2008? How did they do during 2001? So you can prepare yourself for what's going to happen. Most importantly, the second bullet point, I would urge you have got to have a process that can shelter your investments when a recession occurs. And that's really what Prepared Capital is built on. We have a process using our algorithm, that business cycle indicator that predicts recessions, to shelter our clients' investments by moving from stocks into bonds before a recession occurs. Bonds typically do very well during a recession. During the last 2 recessions, in 2001, our models were up 25%. Okay, in 2008, we're up 20%. Those are both periods where the stock market was pretty much chopped in half. Okay, you've got to have a process. As you're reviewing your investments, make sure that you take a look at whatever costs are associated with the investments that you own. Wall Street is built on taking a tiny little sliver, right, of many people's investments, and those tiny little slivers over time add up to quite a bit of wood. Okay, those tiny little slivers add up to a lot over time. So understand the cost of the investments that you own, and understand that and make sure that there are some value tied to the fees that you're being charged. And then the last bullet point, and this is timely given Facebook's earnings announcement yesterday and the stock being down 20%, there is a lot of people have got way too much exposure to large tech stocks today. As we talked about, recessions reverse the trends that were established during the economic expansion. Money has flown into big tech, right? So Facebook, Amazon, Netflix, Google, you name them. You've got to understand what your exposure is there. They are oftentimes the biggest holding in a lot of the funds that people own. They don't realize how much exposure they have. In a day like today where Facebook's down 20%, and we're not even anywhere near a recession yet, that should be a wake-up call. Okay. The last thing I want to leave you with is just a simple piece of math that I think escapes most people. Now, most people understand compounding returns, right? You earn a rate of return on your investment, and over time, that growth goes parabolic, right? It gets bigger and bigger with time. You probably maybe have it in some of the financial projections for your startup. What people don't understand, though, is that when it comes to compounding returns, losses weigh far more heavily than gains. Okay, and I'll give you this very simple example. You have a $100 investment, and you lose 50% your first year, and the second year you gain 50%. Oftentimes people think, oh, I'm back to even, right? I lost 50%, I'm up 50%, okay, I'm back to even. But you're not, right? Your $100 investment, initially you lose 50%. When you gain 50%, it's based off of the $50 you have left, not the $100. So when you take a 50% decline and then a 50% gain, you're actually at $75. And that's what this chart represents. It's how much of a gain you need in future gains do you need to recoup a loss that you have taken. So I started this the presentation telling you about a story about my mother and the dot-com bubble. The NASDAQ, the broad index that captures all tech companies, during the dot-com bubble was down 80%. Okay, it takes 400% in gains just to get back to even, not to grow at all, just to get your money back. And that took the NASDAQ almost 15 years to do. Okay, so what I'm encouraging you to do is have a process for how you protect your investments during a recession, because a recession is close, and recessions are when losses are the greatest. Okay, so have a process in place. With that, I want to jump to a couple of things that both Early Growth Financial can do and Prepared Capital can do to help you prepare. First of all, as you're going through your investments and you want to get some perspective on how your investments will do during a recession, it can be a challenge. There's not a lot of resources out there for you to do it yourself, but this is what we do every day. So reach out to me, give us a call. We can help you with getting a better understanding of how much exposure you have. And that's totally complimentary, right? We just have these conversations all day long. Second, when it comes to if you have raised capital recently, I hope that you don't just have it all sitting in one bank. You need to understand FDIC insurance limits. Your money can be insured if you're smart about where you put your money. And given that the Federal Reserve has raised interest rates recently, you can actually earn a little bit on on the money that you have raised while you've got it sitting in the bank. Last thing I will say, we do offer a monthly market update. Our business cycle, our business cycle indicator is updated every month. Once it updates, we put out a monthly newsletter. Comes out once a month, and it's completely free. If you go to preparedcapital.com, you go to our business cycle indicator page. It's under services. It's easy to find. There's a big blue button there. You can sign up. We'll put you on the list and make sure that you get our commentary so you know when our business cycle indicator warns that the recession is imminent. So with that, that's the Prepared Capital side. I want to turn it over to Alaa again for Early Growth Financial, because they have some things from their standpoint that can certainly help you. Alaa?
Thanks, Phil. That was excellent. Before I get into what Early Growth does, I just have a quick question. Does the venture or the investment world, it doesn't totally dry up during recessions, right? It just becomes more selective. Is that correct?
Yeah, right. Much more selective. I mean, but the total volumes certainly decline. It doesn't dry up. It doesn't mean that there's no investment being done anywhere, but it's far more selective, and it certainly shifts towards the later stage companies because there's less risk in those.
Great. Thank you very much. Yes, as Phil said, I think Phil's message is it's important on a personal side to have this professional guidance because the landscape out there is complicated. I think early growth helps on the corporate side get your kind of house in order. And some of the things that we could help in getting you ready for all eventualities is that by working with a company like Early Growth, that you're a lot more nimble in a changing market environment. As your company grows, you're able to adjust your staffing around the financial and accounting needs, and Early Growth can help you kind of migrate either up or down depending on your business environment. The one thing that all companies need, and very, very early stage companies tend to kind of put it on the back burner, is your financials and your forecasting. In order to to know how to plan and how to address changing market conditions, it's important to know where you've been, and it's also important to plan, and that in the accounting and finance world are financial statements and forecasting. And I think that's Early Growth could kind of help you lay that roadmap and model out different scenarios. So you could know how much money you need now or how much money you will need in the future, or help you with the presentations that you would need and in raising money. The other thing is that we are a cost-effective CFO and senior accountant solution for you versus hiring full-time, especially now when the job market is in certain markets is very, very tight. We're able to help you in that by providing cost-effective solutions that's as heavy as you need or as light as you want. So we're very nimble that way and would help during changing economic conditions. And finally, that you have a seasoned business consultant that is there with you to kind of navigate through the changing economic winds. All of our CFOs are very experienced. They are in the startup ether. So they're not just somebody to figure out the accounting stuff for you and sign off on your financials. They are business consultants with a lot of business acumen that could be great help, especially during turbulent economic times. Phil?
Perfect. Okay. Thank you. I'll appreciate it. So because prepared capital is in the investment landscape, of course, we've got to keep the lawyers employed. So there's some disclosures. But Amanda, why don't we open it up for questions and see if we can't answer some questions for folks.
Yeah, absolutely. So right now we don't have any in there, so feel free to ask any questions. If anybody has them, you can go ahead and type them into the control panel, and I'll go ahead and ask Phil and Alaa for you. Here we go. Is it too late to save yourself once the recession has already started? Do you have a sense for how long a typical recession lasts, and how long will the next one last?
So if we were to go back to one of those first slides, there's a slide that let me just jump back here that shows how long a recession typically lasts. They're typically pretty short. 15 months is all they are. So they're pretty short. However, financial markets tend to peak prior to the recession actually starting, right? If you go back to 2000, the stock market really peaked in 2000. The recession didn't occur until 2001. Same occurred with the last recession. The stock market peaked in 2007. The recession didn't really start until the end of 2007, early 2008. So the financial markets will move in advance as people start to come to the realization that the economy is weakening. So if you wait until a recession actually starts, a recession is actually announced, it's probably too late, unfortunately.
Great, thank you. Here's another question. An inverted yield curve has been very accurate in predicting coming recessions, but I didn't see this in the presentation. Do you have any comments on that?
Yeah, so we did not get into the inner workings of our algorithm, but the inverted yield curve, and just for those of you that are listening in, if that sounds like Greek to you, that is the difference between short-term interest rates and long-term interest rates. And the reason why this is important is because that is the profitability for banks to make loans. And obviously, as we've talked about in this, there's an awful lot of debt out there. The economy runs on debt, unfortunately, and it really requires banks to make a profit when making loans. So yes, the yield curve is something that we look at. It is one of the components that goes into our business cycle indicator. Although I will say this indicator does get a lot of attention in the news these days. It is not by itself a good indicator to track. And actually, we've done a lot of work on this. If you were to use just the yield curve as a decision-making tool for when you should be in the stock market or out of the stock market, it actually got a horrible track record. It's got a great track record of letting you know a recession is coming, but it does a terrible job of telling you when you should be in or when you should be out. So yes, that's an area that gets a lot of attention, especially recently in business media. We use that as one of our components, but I would just urge you, that piece of information by itself can be very misleading. So anyway, hopefully that answers the question.
Great, thank you. The next question is, do you have any outlook on how businesses will view international markets during a recession? For example, would they be more likely to expand and grow international operations to reach other markets if there is a recession in the States, or will they scale back?
Well, so a lot of it depends. Our research focuses on the U.S. economy, right? Recessions in the U.S. economy. It depends on what is the environment in those other countries. So typically, when the U.S. economy goes into a recession, because we're the largest economy, we tend to drag other economies down with it, right? So it certainly is possible if some of these other countries out there, whether it be China, Europe, other areas, are resilient and their economies continue to grow, then of course that's certainly business leaders are going to look to where the growth is, so where they expand, whether that be in the U.S. or internationally. But I don't think it's not a question of whether or not we're in a recession or not. It's a matter of how bad are things here, or how good or bad things are here relative to that other market. So just because the United States goes into a recession, I don't think that means that people necessarily flock overseas, because usually, because we're the largest economy, we tend to bring everybody down with us. So I know that's not a direct answer, but I think it gives you maybe a way of looking at it. It's not just a binary answer. It's got to be, how is the U.S. The performance of the U.S. economy relative to another economy?
Great, thank you. So that's our last question. So if Alaa and Phil, you have any closing thoughts, and if anybody has any final questions while they're talking, I will take a look. Otherwise, why don't we go ahead and close this out?
Alaa, you got any final comments?
No, I just want to thank you for that's a great presentation. I do have just one quick question. Looking at your analysis, it seems like the debt components of the economy are what would drag the economy down. The personal debt and home equity, home finance debt seem to have not gone up as much as the public debt. Will that affect the severity of the next recession, the change in the components of the debt? I'm specifically talking about the government's ability to react.
Yeah, so I mean, so look, the obviously, and what I was referring to is that table that we had with the that give you a breakdown of the where the debt really lies, and obviously the government has gone on a spending binge, right? However, the um, the U.S. debt, right, the government debt, we're still seen as the safest place to invest, right? So when times get tough, investors still flock to U.S. Treasury bonds. So that is still the environment. So the presence of all of that debt, that $20 trillion or nearly $21 trillion now of government debt, is not so much a concern at the moment. Although what it will do is it will limit Congress's ability to expand spending to bolster the economy during the downturn. So I don't think it's not a matter of is going to default. We're a long ways away from that, but you will see politicians that are mainly on the conservative side of the aisle that don't want to expand spending. Right, they're fiscally conservative. But the thing I will say with regard to the other three categories, corporations have got an enormous amount of debt, and for some odd reason, it seems normal now for companies to go out and borrow money, issue bonds, and buy their own stock. Right, stock buybacks. If you were to just Google it, you'll get a bunch of articles about how prolific it is these days. If you were to go walk into your local bank and you said, "Hey, give me a personal loan because I'm going to go put it all on, pick a stock," right? They're going to look at you funny. But for some reason in this environment, and you can rationalize it, and I won't get into how they rationalize it now, but that's acceptable, right? Companies issue debt to bring in money, and they, rather than putting it towards expanding with a new factory or hiring more employees or expanding their business, they think the money is better spent just buying their own stock. So I find that to be concerning, and that's an area where I think that will lead to further stock market declines. Sure, mortgage debt has not grown. It really dropped off significantly after the 2008 financial crisis. So that's not so much an area of concern, but the consumer debt, auto loans are at all-time highs, credit card debt is at all-time highs, and so those areas are concerning. So it's certainly, when you step back and you look at it, yes, there's a ton of debt out there. A lot of it is in the government, the public sector, but even across each of those private sectors, corporations and consumers, it's enough to be concerning, I think. Hopefully that provides some context. Okay, so with that, Amanda, I don't have any closing comments except for listen. I would just say the environment's going to change, right? In the next 18 to 24 months, things are going to change. Early Growth Financial can help you on the business side when it comes to projections, forecasting your financials. You've got to make that bulletproof. So take the time to engage with them if you have not already. And at least look at, well, hey, what if some of these projections we have for our business don't pan out? What if things are a little bit worse than we anticipated? And then the same goes for you on the personal side. If the environment's not going to be the same forever, take the time to understand how things might change and how it might impact your finances. With that, Amanda, hand it back to you.
Awesome. Thank you so much, Phil, and thank you, Alaa. We will follow up with everybody via email, so feel free to reach out if you have any additional questions. Otherwise, thanks for joining us today, and have a good rest of your day.
Thank you.